Hello. We'll talk about FRTB, which stands for Fundamental Review of Trading Book. It's related to market risk, so we'll talk about bit about market risk today, and we'll learn basics of FRTB. Very recent regulations. It's just been 4 years since it has come to force, and it's in fact banks are still struggling to implement FRTB. So we will learn a bit about this topic. So FRTB stands for Fundamental Review of Trading Book. As the name suggests, it has to do with trading book, not to do with banking book. So loans are related to banking book, whereas trading is related to trading book. Okay, so we are not talking here about, let's say, corporate loans or retail loans. We are talking about banks' activities in trading, whether it's trading of commodities or dealing with bonds and trading of derivatives and so on and so forth. In Basel II, market risk was based on value at risk or VAR. However, it was felt that that's not a good enough metrics to measure capital requirement for market risk. And during 2008 financial crisis, it was felt that VAR, value at risk, wasn't really working very well, and regulators actually always act upon things once it has happened. So they realized that, okay, now VAR is not working well, let's come up with something else. So they took many years to come up with something called something different we will learn, but the set of rules that came up after the crisis, you call it as FRTB. Okay, so that's in nutshell what FRTB is. We'll learn a bit of nuances about FRTB. There are two approaches introduced in FRTB. One is the standardized approach, the other one is the IMA approach, which is internal modeling basically. If you are familiar with credit risk, it's your advanced IRB model, right? So that's similar to that. So SA means standardized. That means regulators will provide you calculation formula for your capital. Now, those who are not familiar with what is capital is basically a buffer that you should keep to ensure that in bad days you are solvent. You do not, the bank does not become insolvent. So banks have to keep capital to account for the risk they are taking in the business, in the day-to-day business. And regulator makes sure that banks really keep enough capital for activities. And trading is a very risky activity. Hence, regulators enforce banks to have enough capital for these activities. Okay, and in SA approach, regulators provide the formula for banks to calculate. Whereas in IMA approach, banks can build their own market risk models to build models that then can be used for capital calculation. So now standardized approach consists of three components. One is sensitivity risk charge, and other one is default risk charge, and the third one is the residual risk charge. And these three things are calculated using three different financial metrics called delta, vega, and curvature. Okay. Now delta, vega, and curvature together is calculated, and that constitute the sensitivity risk charge. Okay. In brief, we can call it as sensitivity is how sensitive market is towards the movement how sensitive your instrument is towards the market movements. But that's only the first part. Okay, there are two other parts: default risk charge and residual risk add-on. Now, default risk charge, or is called also DRC, is it's more like a extra capital that you need to incur for stressed or more default scenarios. Now that's something sensitivity risk size cannot properly take it into account. Hence DRC or default risk charge is required, which takes into account more stressed and sort of default incidents into account. And the residual risk charge is something that is on top of these two, which is more of an add-on if in case regulators feel that first and second, the SRC, sensitivity risk charge, and default risk charge together are not enough, and that's when residual risk add-on is added. Okay, as I said, default and stressed events are assessed in DRC, so that's something we have already discussed, right? In the internal model approach, you have expected shortfall plus default risk charge and stressed capital add-on. Now the second two are same. The difference is of course coming from the expected shortfall. By the way, this delta, vega and curvature are something given by the regulator, so you don't have to build models for them, okay? Whereas the expected shortfall here in this case is a replacement for value at risk, and expected shortfall is something that banks have to calculate themselves, as well as default risk charge, by the way, both. And stressed capital add-on is something that is on top of expected shortfall and DRC. And so what's the difference between expected shortfall and value at risk? Well, value at risk was used to know that at certain percentage confidence level, for example, let's say 95% confidence level, what is the probability of losing a certain amount, right? So you can say, okay, there's 5% chances, there's 5% chance that you will lose more than $5,000 in the next trading day, okay? So for a 24-hour trading or one-day trading horizon, you basically calculate VAR as 5,000 at 95% confidence level, $5,000, right? So the problem is that that does not tell anything about the expected loss, because sometimes in very rare event the losses could also be higher than that, and and sometimes significantly higher. So it does not tell anything about the tail aspect of it. Whereas expected shortfall takes into account more of an average view of the future. So at 95% confidence level, how much I can expect to lose. Okay. So it takes more of a probabilistic approach, wherein you multiply the probability with respect to the average losses. You can then calculate the expected losses at that confidence level for a given period. And DRC is again similar to what we discussed, but here in this case you have to calculate through models, not through regulatory formula. And stress capital add-on is something that is again on top of these two. Okay, a bit about the expected shortfall we have discussed, which is expected shortfall replaces VAR. It's about average expected loss at a given confidence level, and it is sensitive to tail risk. That means unlike VAR, which is not sensitive to tail risk, and tail risk is a problem in all kinds of market modeling, where you have sometimes fat tail, but in this case